Hey guys, what's happening? It's Ali here with Global Trading Team. I just want to thank you guys for coming back here on a Sunday night, looking to review some of our content that we're trying to produce for you guys. We've had a lot of questions here, and we're trying to get to as many, videos here as possible to try to help the team grow. We'll try to do this on a weekly basis. Unfortunately, today we were not able to do a live session, as I stated in the Discord. So what I try to do is to fill in here by producing another video for you guys. So let's just jump right into it. Everybody's doing great. So I'm happy that everybody is learning here with the team. So let's flip back here. I'm going to screen share my TD Ameritrade Thinkorswim platform here. The reason why I like TD Ameritrade, it's for the most part, it's pretty simple. A lot of people find it a little more on the technical side, a little bit more difficult to use. I like it for many reasons. The chart layout is pretty cool. For the most part, it allows you to do a lot of different customization that helps you with pretty much your own technical analysis. So if you like charts a certain way, you like your studies a certain way, you don't have to just, go right into the default settings. You can actually customize it however way you want based on what you're looking for. So this is a chart that I kind of put together a little bit. And this is kind of a study that I've saved over time. So it's pretty, for the most part, it's self-explanatory, and that based on how you set it up. So obviously it's going to be a little foreign to somebody who hasn't played around with it, like I said. But for somebody like me who spends a lot of time charting at night and stuff like that with Tanner, it's pretty easy to understand. So let's talk about a couple of things here. And I wanted to do something a little more basic for you guys. It seems like people want to learn a little bit more about options, which I appreciate, guys. And it's great that you guys share that enthusiasm for learning about options. Options is a great way to leverage your account, especially if your account is smaller or on a smaller side. You can pretty much use a lot less capital to drive or leverage a much bigger, more expensive stock than you normally would trade. So we talked about this in the last video. 100 shares of, let's say, Apple at $136 or $137 per share. Let's just say it would cost you somewhere around $13,000. But if you trade an option contract, you can probably pay anywhere between a couple $100 per contract to maybe $1,000 a contract, depending on how far out you go out in time or how close or how far out of the money you are. So it's a great way to basically hedge your account also against with downside risks in the economy or in the market. So if we see or anticipate any market pullbacks, options is a great way if you're trying to protect your downside with shares, or you anticipate or speculate a big move in the market, let's say going into earnings week or following the weeks after earnings week or post earnings week. You might enter a position knowing that the stock has pretty good fundamentals and is expecting pretty good or pretty strong results as far as earnings goes, and you want to increase your position size to capture more of pretty much that run. So a couple things here I want to mention, guys. Options is very risky. I think a lot of people understand that by now, especially weekly options. The reason for that is there's a less likely of a chance for a stock to move in that direction or hard in that direction by a certain time. So people who look for these cheaper weekly options, it's a hit or miss, guys. If the stock doesn't gap up to that strike price or start to move more than let's say if you were swinging it, it could lose a ton of value, and then you're probably in the red by a certain time, or you lose a lot of profit because market pullbacks, maybe the market is choppy the next morning, the stock trades sideways for a couple of days, that destroys your premium. So I know we talked about this last time, so let's go here on a trade. This is basically where you go to figure out, let's just say here, I'm going to flip back to NEO. A lot of people know NEO, so I'm going to go back here. I own shares or a ton of shares here, but I'm using option contracts here for education purposes only. So I wanted to give you guys a better visual of strike prices and whatnot. So we understand now that NEO is trading somewhere around 59.85. I think it closed around 60.15 after hours, so just a few cents higher than the close, which was In my opinion, what was needed and what we were hoping for NEO to do is to close above 60 for the week. Hopefully, the next week will be a better run. We hit $64 during the week, and then we pulled back. We fell a little under 59, recovered a little bit. The market was choppy. 2 or 3 days the market was in the red. So, but anyways, $60 is where NEO is trading at here. We talked about this is the option chain, right? Where everybody can see here. And we can pretty much space it out however way we want to. And I'm just going to go and kind of keep this a little as simple as possible. So February 19 would be this upcoming week. If somebody was looking to trade an option contract on NEO, we understand that the earnings for NEO is speculated to be on March, or anticipated on March 1st. So we don't like for any of our traders or investors to trade options going into like an earnings week, because of the implied volatility is supposed to be higher, especially if they're speculating that the stock is going to move in either direction, whether it's 10, 15, 30% either direction. If it does not move in that direction or hard up in that direction, then a lot of that premium will get destroyed or jacked. You're going to lose a lot of that contract value. So we try to stay away from trading those weekly contracts for the same reason. Or trading option contracts on, let's say, earnings week. So a good strategy to trade NEO, possibly, since NEO is the type of stock that likes to pull back after good catalyst. So a lot of it sometimes is priced in. We've seen that with delivery numbers. NEO would report great delivery numbers. Sometimes it'll shoot up and then it'll take a nice pullback, or sometimes it's just priced in. It pulls back lower than what the previous closing price is prior to, let's say, a good report on delivery. So a good way to possibly play, and this is totally speculation, guys, here. I'm not advising you guys to play this or get into these option contracts. It's only what we've noticed here based on previous trades or previous experience here with trading option contracts. Since they're reporting, or NEO's reporting earnings on the 1st, you might want to go a week or 2 weeks after that. So maybe March 12th, let's just say, or maybe possibly March 19th. That might be a good play, especially gives enough time for stocks to recover if there was any pullback, and your premiums won't necessarily get destroyed. So let's just choose March 19th here. So we have a 14 strike price range here. So what that does is it gives you, let's say the stock is currently trading somewhere around $60. It'll give you about half of it on the downside, as far as in the money or deep in the money. And then you'll have a couple contracts that are near the money or at the money. So that's just a spread. I like to default it to 14. Some people like to go a little bit further out. All would be a little crazy. I mean, that's going back to almost all option contracts at different prices. And that's not a good strategy. Probably somewhere close to 8 or even 12, I think, is probably good when playing, because you don't want to be too far out of the money when playing option contracts, especially if you're not giving the contract enough time, right? Part of contracts, right, you have time expiration that you have to keep in mind. So you got the strike price, the stock's got to move above that strike price, or you can play the premium side of it, right? A run that the premium starts to increase over time, especially if the premiums, if the stock price is moving harder in that direction, then the premiums might jump up a little bit higher, although you might still be far from the strike, right? So a good strategy here would be a $60 strike price going into March, let's just say 19th, or as we clicked on here. So a $60 price or strike price would probably be somewhere around $720 per contract, maybe $715 between the bid and the ask. So if you looked at it here, if you clicked on the option contract, obviously you want to keep in mind what the amount of contracts you're looking to purchase. So let's just say we're looking to purchase one contract. It's a single contract, right? That is the date right here, the expiration, March 19, 2021, at a $60 strike. Make sure we're selecting a call option. So calls will be on the left right here. Here's the date and the strike. As we can see here, we have the bid and the ask here, right? And a couple other things that I'll discuss later on here, but for you guys to see. So you want to make sure if you're buying a call that you're selecting the type that's a call. And you can do this manually here. Even if you accidentally clicked on put, you can always edit your option or strike type here. You can select your limit price. So if you're looking to pay or buy at the ask, which you would probably get instantly filled, assuming that the price or the premium doesn't jump up. Or you can say, hey, you know what? I want the price to decrease to a certain number, and these are 5-cent increments. So assuming that the stock pulls back at the open, let's just say it goes down and the stock loses about $100. So let's go to 620 to be on the safe side. The stock pulls back a little bit at the open. That'll probably give you a better feel of execution. Again, this is a chance that you're taking. The stock can open up and just keep pushing higher, and you might not even get filled. It might cause you to chase a little bit and get in at a higher premium per contract, right? So you got to be careful here. Again, you have to know, be content with your strategy, whether it's to sit patiently at the open, which we don't ever advise for somebody just to jump in right at the bell. Again, there's not enough data for you guys to go off of based on, whether the stock is going to continue to move up or it's going to have a little morning dip at the bell. So look for areas of trends first. Identify the trend before jumping in. Figure out where your nearest support level is, where your nearest resistance level is, and figure out where the trend is going. Follow the market. See if the market is trading sideways, a little choppy, because that can influence how the premiums react to that price, especially if there's a small dip here. The good till day, so this is a day order, so we're selecting a day, so we only want this day to fill, this order to fill here on the day. So at the closing bell at 4 o'clock, that order will automatically cancel out. If you're looking for a good till cancel, GTC, basically it's just an order that stays open for probably a couple of months, if I'm not mistaken, sometimes even 6 months. It depends on the time frame. I think with shares, if you put a good till cancel order, it's around 60 days or 6 months or 180 days. And then that order will cancel out if this was a good till cancel order to sell further in the future or buy further in the future. You don't have to worry about the instruction here. Best is just basically the exchange of where it's pulling that option contract from. So at the very bottom here, you can pretty much, you can actually do this here. And I've never really done it here where you just play with the option contract. This is the midpoint between the bid and the ask. So you could kind of ignore that. But at the very bottom here, you're going to hit confirm and send. And that's how basically you place your order and send. You'll hear a little notification here at the top. And that'll let you know that your order got filled. Somewhere around here, it'll be a drop-down notification. It'll say +1 contract was filled. Now, for instance, if you were, I'm going to flip out of this screen because I do have a position in NEO, and it'll pop up here. Let's just take a look here. It'll pop up on my screen. I don't want that to happen here with my my shares and position size. But let's just say we're trading Blink here. The active trader feature is very nice here. So a couple things I want to go over, guys. So this is my main chart here with Thinkorswim. Of course, I have my studies here. It's for everybody to see. I have the 9-day simple moving average. I like using a 50-day. This is marked red right here. My 50-day simple moving average to determine, the nearest trend. Of course, if the stock is trading above, that's a good bullish sign. If it's trading below, it could be slightly bearish. So, and of course, your 200-day moving average right here in green. As we can see, Blink here is trading well above the 200. It's actually starting to catch up to it a little bit closer in time. But you can see that big move up from that $9 or $8 range kind of separated it very far from, let's just say, the 200 moving day average. Over time, as that price starts to trade a little more sideways in a closer range, that 200-day moving average will basically start to creep up closer to the current price, and it'll start to make sense as you see time goes on. The 50-day moving average is pretty important. A good idea here is whenever the 50-day moving average is crossing above the 200, seems like that's a pretty good bullish sign. An intraday bullish sign would be a stock trading above the 9, obviously the 50 and the 200. So we've seen it here in this pattern. It came up above here, above the 9. It consolidated near the 9 for a pretty long time. It broke below the 50. It pushed right above the 50, above the 9. It created this little kind of like a bullish, not even really a flag pattern. and then pushed back down under or below the 9-day simple moving average, consolidated near that 50-day moving average. But we'll talk about this more in the next video. The volume bar here is a subgraph here. I like it here below the chart itself. Your RSI is your relative strength index, basically tells you where the stock is being, what type of pressure, whether it's an overbought position or oversold. As the stock starts to move up higher and higher, it starts to cool off right here around this area. And then this is called an overbought position, right? Overbought on the RSI, meaning that it's been, kind of separated from the average, possibly rate of return. So as it pushes closer to the neutral area around the middle, there's I'm not going to say an unclear direction of where the stock is heading, but more of a cooling off period. Definitely whenever a stock pushes below, right here, below this area of 30, this is considered an oversold position. So usually when the stock is oversold, for instance, the stock pushed up greatly here. Let's say for Blink, it pushed up somewhere around $40 or $37, $38. And then it sold off heavily from the 39 area all the way to, that's kind of like a $19 area. So as you can see, the RSI definitely took a steep drop here, right? So is the MACD, right? So that's your moving average, convergence, divergence. As you can see, it's oversold here. That creates another opportunity. So this is kind of a buy signal when the stock is oversold, right? And a lot of traders pay attention to these different time frames, of course. So right now we're using a 180-day 4-hour time frame here. As we can see at this level right here, the stock was overbought, and then obviously there's a lot of profit taken here. So the stock suddenly becomes oversold. It becomes an area of consolidation, and then some buying pressure starts to push that stock back up. As you can see here, the MACD, the blue cross over the white, which is kind of a bullish sign here for us. Whenever you see the bullet or the blue line cross below, and that's different averages here. So you can see your 12, 26, 9, but whenever that crosses below the white line right here, that can indicate a bearish sign, or a stock is going to take a little bit of a pullback. And that's what we're seeing here right now. We're noticing a oversold position here back around that $50 range, 52, 51, with a lot more room to come. So the RSI and MACD definitely cooled off here. We might even end up seeing a little bit of a crossover here at the bottom on the MACD. Once this crosses over the blue, the white, you'll turn this, almost instantly becomes a buy signal. It's almost like a golden cross, which, people refer to that as really more of the 50-day cross and above the 200. So that's considered a golden cross move, buy signal. So active trader, I'm going to just go over here a couple of things here real quick before we do anything else while we're here on the chart. So let me just take a look here. Time and sales, guys. A lot of things we don't pay attention to, and this is more for day traders more than anything. So day traders use time and sales for many reasons. Time and sales is basically at near areas of levels, key levels of support and resistances for breakout levels. Like, this is very important, guys. If you're looking at Tesla, for instance, let's just go to Tesla here for a second. I haven't charted this in a while. Oh, there you go. Okay. So Tesla is very important when it comes to breakout levels, just like any other stock. But as soon as we approach areas of, let's say, resistances or key level resistances or key levels of support, a lot of day traders like to pay attention to time and sales. Time and sales gives you some other different data, guys, other than the volume bar, right? And the RSI and MACD. Time and sales will actually show you what type of orders are going in at those levels. So it'll give you a time description here. It'll give you a price of where these orders are being executed, and then the size of the order. So if it's 1,000 shares, 500 shares, a couple thousand shares, you'll see time and sales will basically display different fills here in execution. So that's very important if you're looking at it more on the technical side while being a day trader, let's just say, or intraday trading. It's very important to see. And as you see, the levels of asks or the prices of the asks increasing, there's a good at near levels or key levels of resistance, then that can kind of signify that the level of resistance is coming close to being broken. So that you might break over that key level, let's say $900 for Tesla. If you notice the time and sale, I'm sorry, on the bid price is actually going a little bit higher than or being moved up to the ask, that could be a signal that this key level of resistance is about to be broken. How do we figure out if it's going to be broken? So as the orders start to fill here, you'll see basically a big igniting bar, right, that would release right above this level. So I don't really have too much here to show. So at this near level right here, we see the top of the wick. So there is not an igniting bar here. That's just at the top of the candle on a 4-hour chart. We broke above the $900 and pulled back. An igniting bar would be a volume bar. So a bar that has a ton of volume behind it that breaks through a key level of resistance, right? And kind of something like this, guys. This bar right here has a ton of volume for the most part, or a volume bar like this that basically closes at the higher of the candlestick. But that ignites basically a lot of buying pressure to the upside. So maybe we'll talk about candles, different formations of candles in a different video. I think it's a little more of an advanced strategy to pay attention to, especially if you're looking for breakout levels. There's something called a 3-bar play or a 4-bar play, which is a great buy signal to the upside. So let's take a look here. So active trader is basically another great way for day traders to execute fills almost instantaneously. So the time and sales, you can always keep it on here. It's depending on the size of your monitor, or if you have multiple screens open. You can have your time and sales open here for you guys to take a look at as the orders are nearing above or at key levels, as we discussed, whether it's support or resistances. If the stock is breaking down to the downside, you can definitely use time and sales to see if the bids are actually dropping or the asks are coming down, and that can signify that the buyers are starting to step away at key levels of support from holding a stock from breaking below. If we start to notice that based on time and sales, then that's probably an area where the stock will probably break through. That old level of support can turn into a key level of resistance, right? Old supports can become new resistances. So vice versa, old resistances can act as key levels of support once they break out to the upside, of course, with areas of retest and confirmations. A retest or a confirmation would be that the stock price will break through above that key level and then come back slowly and retest that level that it broke above for a few periods at a time, right? And that's how a strong level of support resistance is formed, right? Buyers and sellers are lined up at that key area or that supply zone. And as long as that level holds, then that can signify a strong level of a resistance or support. So that's basically your supply zone, and that can happen, like, let's say at the $900 level here for Tesla. If $900 is broken, then that old resistance level can now turn into a key level of support. As we can tell here, it touched it multiple times right around the $900 before breaking below. So that 885 to maybe 900 could be a kind of a supply zone for Tesla, but surely above the $900, as soon as it breaks above it, it might go to 905, 910, maybe 908, come back to that 98, 900 number, retest it a few times before continuing back to the upside. So that happens a lot, obviously, with a lot of stocks, guys. We noticed that a lot with NIO. That $60 level was a key resistance level for a very long time. NIO struggled to break above, and when it did, it took off. And when it touched that $64 level, and then it slowly retested that $60 level. 59.85, $60 level was that key level of support because it was a strong level of resistance in the past. Like I said, old supports become old resistances can turn into new supports for the stock. So going back here to active trader, we'll just touch base on this very quickly before this video ends. Active trader is a great way for you to execute, and you can customize this however way you want. So there are different buttons that you guys can incorporate here. And that's buy at the ask, buy at the bid, cancel all orders, cancel all buys or sells. sell it to bid, sell it to ask, and you can customize it however way you want. There's so many different ways to do this. You can actually change the button sizes here for if you want a quick fill, like 5, 10, 30, 100 contracts, or 1,000, 2,000, 5,000, 10,000 shares at a time. You just click on the button, and as soon as you come to the order side, right, you have your bid size. So if you want to execute an order at, let's say, Tesla is trading somewhere around 816 or 817. If you want to use this is a tighter range right here, but let's say we want to get in at a 816, 85 level. You would just simply put your order here, tap this right here, and your order might get filled right away. You'll see your profit and loss here on the day, and also your total profit and loss here on the open. So it's a good way to execute, guys. This is more for live trading. It's for swing trading. You can use it if you're sitting at your computer, but it's really used or designed for traders to get in and out of a position without actually going in and submitting an order and editing the order type and whatnot. This is for faster execution to get in and out as smoothly as possible. So, and you can customize this however way you want. Same thing on the sell side. So if your order was executed, the stock goes from 816, let's just say with Tesla, and now Tesla is at, let's just say 818.40 level, and you want to take profit, about a $2 upside move here. You could just tap on this right here. It'll send the orders. There's different ways of doing this, guys. So you can customize this however way you want, like I said earlier. So there's ways that you can have an instant order fill. There's ways that you can ask for a confirmation. So a quick send feature, which is pretty cool, but can be very dangerous as well if you decide to change your mind, or let's say the price just drops below right as soon as you're about to place your order. It'll instantly fill if you got that confirmation set up. It'll give you an extra second or so to rethink your position size possibly, or the level at where you're entering or exiting a trade. Anyways, guys, thank you so much for watching. I hope this video helps you guys a lot. I'll be including more, let's say a part 3 to this video, which talks a little bit more about buys and sells, order execution here with the TOS platform. Like I said, I have nothing but good things to say about TOS for the most part. The order executions are pretty good on most days. From time to time, we'll have a couple of delays, but at the same time, the active trader feature here for day trading gives you a pretty cool way of filling on or executing orders. Like I said, the Thinkorswim platform here with charting, the different technical setups, the different studies that you're able to have, just makes it a lot more easier to understand. There's a lot of customizations that TOS allows you to do. So if you're a person or a trader that likes to be a little more intuitive with your own charts or your settings, I think TOS could be a great platform for you to use. I would kind of stay away from Robinhood. It's great for maybe small positions, but for order executions, I think there's so much other better platforms. Although Robinhood is one of the best looking platforms in terms of simplicity, I just don't think that their order execution is going to be great, especially if your account size is bigger. With their lack of customer support, it's email only. There's so many different glitches, bad fills on orders and stuff like that. Like I said, if you're using it for long term a little bit, it might be a little bit different, especially if it's not, the pricing or the position that you're in is not so sensitive to the volatility of the market, then you might be okay with it. But with options trading, it might be okay for beginners, but when you become a little more advanced, you definitely want better execution. You definitely want customer support, not have to wait a day or two for a person to respond to your email, hopefully answer your question, and then not having to respond back with another email. And that can take a lot more time, especially if you're in a critical position where you need some support. So thanks again for watching, guys. And we look forward to a great week with you guys. Talk to you soon. Thank you.